Rent your old house too long, and you'll lose $250,000 in tax-free money. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no taxes using my zero tax blueprint. Renting out your old house doesn't erase what you owe when you eventually sell it. Before you put a for rent sign in the yard, here's what actually changes the day your home becomes a rental property. The moment you convert your home to a rental, you start depreciating it, but not necessarily based on what you paid for it. Your depreciable basis is the lesser of your adjusted basis, what you paid plus improvements, minus any prior depreciation, or the property's fair market value on the date of conversion. If your home appreciated since you bought it, you use your original cost basis. But if your home lost value, you're stuck using the lower fair market value, and you permanently lose the ability to depreciate the difference. This catches people off guard constantly. You don't get to pick whichever number is bigger. The IRS makes you use whichever is smaller. Once your home is a rental, any loss it generates is passive under Section 469 by default. That means it can only offset passive income, not your W-2 wages and not your business income. But the conversion year itself is even more restrictive than that. If you lived in the home before converting it and you lived in it for more than 14 days that year, that triggers Section 280A's personal use rule, which classifies the entire property as a residence for that whole tax year. And once that classification applies, your deductions are capped at your rental income for the year, not passive income from elsewhere, not any income, just whatever rent you actually collected during those months it was a rental. If your rental income is less than your expenses in that first partial year, the excess doesn't offset anything. It simply carries forward, still subject to the same limitation the following year. This is exactly why the reps and short-term rental loophole strategies matter here. If you don't qualify for real estate professional status, and this isn't converted into a short-term rental with material participation, your losses just get suspended. They carry forward, waiting for future passive income or the eventual sale of the property instead of doing anything for your tax bill this year. If you haven't watched those 2 videos, that's the first thing to figure out before you convert, because whichever one applies to you determines whether this rental actually helps you today. Here's the part almost nobody thinks about until they sell. As a primary residence, you could exclude up to $250,000 of gain for single or $500,000 for married filing joint under Section 121. To qualify at all, Section 121A requires that you've owned and used the property as your primary residence for at least 2 of the last 5 years before the sale date. And that 5-year window matters a lot for someone converting a current home into a rental. If you move out, rent it for up to 3 years, and sell before that 5-year window closes, none of that rental period counts against you. You still get the full exclusion, subject to the dollar cap. But push past 3 years of rental use before selling, and you fail the 2 out of 5-year test entirely and lose the exclusion completely. This isn't an area where a little more rental time costs you a little more exclusion. It's a cliff. Full exclusion on one side of that 3-year mark, zero exclusion on the other. And depreciation recapture under Section 1250 is never excludable under Section 121, regardless of which side of that line you're on. Every dollar you depreciated while it was a rental get taxed on the sale, no matter what. Say you lived in a home for 7 years, then moved out and rented it for 2 years before selling. You're still within the 5-year look back, and you still clear the 2 of 5 year test. Now, stretch that rental period to 4 years instead of 2, same 7 years of prior residence. You've now rented it out for more than 3 of the last 5 years. So you fail the 2 of 5 year test outright. You don't get a smaller exclusion, you get none. The lesson: for a home you're converting to a rental and eventually selling, the exclusion doesn't taper off gradually. It's fully intact if you sell within roughly 3 years of moving out, and it's gone entirely if you wait longer than that. That 3-year mark is the number that actually matters here. Converting your home into a long-term rental can work well, but it starts a clock you need to understand. Your basis might be capped, your losses might be stuck as passive, and your Section 121 exclusion is either fully intact or gone entirely, depending on which side of that 3-year mark you sell on. If you're thinking about renting out a home you currently live in, know your timeline before you decide. Selling at 2 years versus 4 years after moving out isn't a small difference. It's the difference between excluding your full gain and excluding none of it. Subscribe for more strategies like this every week.